The opportunities and prospects of the 2018 budget of consolidation for the Nigerian capital market came to the fore at the second Securities and Exchange Commission budget seminar in Lagos. It was an opportunity for stakeholders to converge and explore how the 8.6 trillion naira budget presented recently by President Muhammadu Buhari will impact the capital market. Giving his opening remarks, the Director General of the Securities and Exchange Commission, Mr. Nwan Ogwazo, informed stakeholders that the SEC Nigeria Budget Seminar, which was the second since inception, was a platform for assessing the way the capital market can contribute and also benefit from the budget.
Given the state of the economy and the size of this budget, there is no doubt that the economy would be impacted, and consequently, the capital market should be able to leverage on it. Also, the federal government current debt strategy, which is to structure the federal government borrowings in favor of external debt against domestic debt. We believe that the capital market would also leverage on that window. Also, the balance of the deficit in the budget will also be financed from the proceeds of privatization of some of the non-oil assets by the VPE. This is also, we believe, an opportunity for the capital market. And all this will affect the debt capital market, the equities market, and the ability of companies to raise funds in both the money and the capital market. And in financing the 2018 budget deficit, we believe the debt segment of the capital market will drive some immediate benefits. The capital market will also play a very important role in the privatization of those enterprises that the budget has highlighted. So how would the Nigerian capital market contribute and in turn benefit from the 2018 budget and its implementation?
The head research at the Securities and Exchange Commission, Dr. Folabi Olowokere, who was the guest speaker, gave insight into the 2018 budget and implications for the capital market.
These are key summaries. We said the expansionary 2017 budget is necessary, to return the economy to the path of growth and recovery. In financing the budget deficit, we said the debt segment of the capital market would derive some immediate benefits, and also stock performance of companies that produce or supply goods to the government priority sectors would likely improve. Of course, we were saying this when the capital market was down. And we said that, however, the process of financing budget deficit will further crowd out investment. And this will go through the interest rate channel and the exchange rate channel. We also look at how can the capital markets contribute to the budget and planning. We identified four. We said the capital market can provide platform for selling government shares during privatization. And we know that the budget of this year, part of it will be financed by privatization proceeds. Part of the deficit of the budget will be financed by the privatization proceeds of non-oil assets. We also said that the capital market can serve as market to government when trying to fund budget deficits through bond issuance. I mean, we've been seeing that a lot. This other one is a good characteristic of the capital market that we probably need to explore further. That the capital market can engender transparency among listed firms, thereby easing government tax receipts. That can be an advantage and a negotiation tool in the hand of capital market to say, come and list, government support these firms because you can have easy access to their financials. Let us look at 2017 budget. It's a budget of 7.44 trillion, and capital is 2.17 trillion. The second column, this column, looks at the actual as at June 2017. Out of the 7.44 trillion, expenditure that has been made was 1.39 trillion. And by that June, there was no capital expenditure or no capital disbursement. Here, we assume that if we must have the same implementation rate that we have in 2016, for instance, I mean, economists assume a lot. Let's assume government works towards the same implementation that we had in 2016, which was that 84.8% of expenditures were carried out. In that 2016, 6.6% of capital expenditure were done in 2016, and the remaining 70.2% were done between January and May 5, 2017. So if you look at the implementation of capital, it was 76.8%. If we then assume that the same implementation rate is achieved in 2017 budget, it then means that the government still needs to spend 4.92 trillion between July and December 2017. In terms of capital, the government still needs to spend 1.67 trillion. Of course, after this thing was released, government has disbursed 450 billion. So that's why we say less 450 billion. So we try to see what can be the implication of this budget for the equity market and for the debt market. Everything is based on assumption that if we have oil price of above $55 per barrel, peace in the Niger Delta, that you can have maybe production of 2 million and above, and a stable exchange rate. Of course, if you have those two, you have a stable exchange rate. Implementation of the budget, implementation, not just the budget, implementation of the budget will contribute to economic growth. And if that is done, in such an environment, the stock market will maintain the current growth trajectory. Maybe not very big, but at least it's going to be, because it's recovering. And why are we saying that? Because there will be increase in aggregate demand. When there is an increase in aggregate demand, companies sell more, and when companies sell more, they have higher earnings, and it affects their performance on the stock market. Forex availability will aid their access to raw materials. Listed companies that are contractors to governments will get their money, and they declare more dividend and earnings for their investors. And government's expenditure on cost-reducing infrastructure will generally benefit everybody. And if domestic borrowing is actually reduced, companies may have access to more fund and cheaper fund. Of course, we know the relationship between cost of fund and firm value. Cost of fund comes down, firm value go up. And firm value go up, earnings go up. Earnings go up, prices go up, and returns are positive. There will be preference for equity if interest rates can fall. Of course, that's the alternative. And then if there is reduced uncertainty around exchange rates, it encourages FPI. Because you need to do that, because when other countries are trying to raise rates, you must also do something that will, if you can't raise your rate, you must create certainty in your exchange rate management system. So, what environment affects our predictions? We should always be considering the plan, the medium-term plan of the government, which is the economic recovery and growth plan. And in that plan, as we presented in one of our meetings, in that plan, there are specific things that are mentioned on the capital market. On economy diversification section, there are things specifically for private equity and venture capital players in the development of SMEs. In the chapter on competitive economy, there were issues around infrastructure and diaspora bonds. In the chapter on investing in our people, there were suggestions on green bonds. And in the chapter on governance, there were the use of capital market by subnational to raise money. In addition to this, when we did our analysis, we also suggested that privatization through listing, because there are privatization issues there, they should be followed through by capital market. How to explore capital market instruments to address housing deficit is very important. Government mentioned housing deficit, there are funds for it, but how does the capital market key into those funds? We should be thinking about those things. Then the Commission has rules on revenue bonds and wants subnationals to key into it, not just for general obligation bonds, but borrow the money, use it for projects that can return money. But most of the time for subnational, you may also need some kind of private-public partnership so that those things can be done properly. So capital markets should be thinking about those things. What have we said so far? That the government budgets affect the economy and the capital market. Therefore, capital market players need to pay attention to these effects and their roles. Governments allocated a substantial amount to capital projects in 2017 budget, but only 450 has been disbursed so far. Much still has to be done. The good news is that the economy is back on the path of growth and prices are gradually falling. There is increase in external reserve and forex market is stabilizing. The capital market is recovering as companies post improved earnings. The president presented the budget on 7th of November 2017. Proposed expenditure is 8.612 trillion, 15% growth over 2017. Capital expenditure will be 30.8% of that. Deficit is 2 trillion. 850 billion will be financed locally and 850 billion externally. The balance will be financed through privatization proceeds. If the current macroeconomic environment is further stabilized by the 2018 budget, the capital market is forecasted to grow steadily over time. The equities market will benefit from increased economic growth, exchange rate stability, infrastructure, and lower interest rates. The fixed income market will further benefit if externally issued instruments are also listed and traded domestically. Capital market players also need to take advantage of the ERGP and new technologies. Emerging products and opportunities in the global and local environment should be explored, while all this should be analyzed in the context of the domestic, political, and global economic environment.
Mr. Bayorotimi, CEO Quest Advisory Services, shares his thoughts on the 2018 budget and implications for the capital market in 2018.
The budget appears ambitious, it appears aggressive in terms of revenue expectations. So the critical question is, where will the revenues come from? Significant sum, 63% is supposed to come from non-oil. That is a daunting task because we're an economy that is just emerging from a recession. The growth is still rather fragile. So I would rather government is a bit more conservative in its expectations and thereafter puts the necessary support system in place to drive increased private sector participation. If we see significant private sector participation, then we can actually move this economy along much quicker.
The 2018 budget has been described as an ambitious one from the government. Stakeholders at the end of this seminar believe that the commitment to implementation is key. Also, they agree that policy incentives for private capital investments is critical to ensuring that this drives capital market activities.